Hello and welcome to another video as part of the technical analysis series. Today we are discussing pattern failure. Here's the outline for today's video. Disclaimer first and foremost, and then quite simple table of contents. We'll go into pattern trading logic, what it means and what the central premise of pattern trading is in general. We'll go over pattern failure logic, that is how to come up with good trade ideas when pattern traders fail. We'll look at some examples of pattern failure, cover some nuances, and then conclude. Before we get going, I just wanted to express my thank you very quickly for the literally years of support on this series. I think 2017 or 2018 was the first video. We've built out quite a knowledge base, and your support throughout all these years, despite a lack of consistency, is very much appreciated. I hope you're still finding value in these videos, the updates, and I appreciate all the likes, subscriptions, comments, feedback, engagement, and all of that. Thank you, and I hope this continues to be a useful resource for you and something to share with people who care about trading. So disclaimer, first and foremost, again, pause the video if you must. I'm an idiot. I don't know anything. This is for fun. This is satire, comedy, entertainment, performance art at best. I don't know what I'm doing. So pattern trading logic, and I think this is going to be one of the more useful videos in general because it's not specifically tied to one particular part of trading. I think it's just a useful way to think about the market in general, regardless of what system you use to generate signals. So with pattern trading logic, if we take a step back and think about trading logic in general and sort of reverse engineer how one might come up with ideas, we're left with three basic steps. And this might be even a useful framework if you don't have a way of thinking about how you approach the market. And these are the following three steps. The first is, what's the thesis or idea? Sort of, what do I think the market is going to do? Usually this is directional, but not necessarily. The second one is, once you have an idea for the market or a thesis, what are the entry parameters for that thesis or the entry trigger? What is the mechanism by which you actually take that idea and put it into action and decide to actually put some risk on the trade? And then the third one is regarding invalidation, stop loss, risk management, whatever. Those are the exit parameters for that trade, or where is this idea wrong? Now, in general, when it comes to pattern trading logic, the first and most basic premise is that traders observe patterns. Now, as mentioned, the term patterns is used in a very, very broad sense. Now, in general, patterns can generate trade signals. So traders will spot these patterns, which are some form of repeatable, replicable signals in the market that are identifiable. And these patterns can generate signals, which is to say create positioning based on those patterns. Could be longs, could be shorts, could be a view on volatility, whatever it may be. Now, as mentioned, pattern is broadly defined. You have chart patterns, which is your usual TA, triangle, wedges, whatever else. You have price patterns, your swing failure patterns, specific candlestick structures, whatever it may be. You have structural patterns, again, fairly TA oriented to nobody's surprise, but these are sort of horizontal breaks, diagonal breaks, and shifts in structure. And then also you have indicator-generated signals, your momentum divergences, your moving average crossovers, and whatever else you may use. Even on-chain stuff is valid here. Now, the core premise of pattern trading, I kind of touched on this earlier, is that similar patterns will resolve in a similar fashion. It's their repeatability and replicability that makes them a source for trade ideas when it comes to speculation. And these properties that I just described create a lot of positioning based around patterns. Because they are easy to identify and they repeat themselves, traders backtest them, study them, and as a result end up acting on them. And a lot of the time, depending on the pattern, these features create built-in parameters for trading specific patterns. That is to say, trading rules pertaining to those specific patterns. Take a shot every time I say pattern in this video if you want to die of liver cirrhosis. So when it comes to examples, here are some basic ones. I won't need to give you chart examples at this point, hopefully, but we will cover some later. If you take a standard head and shoulders top pattern, you'll know that the sell is triggered on the breach of the right shoulder, and the target is derived from the distance between the sort of head and the neckline. Again, somewhat arbitrary, but if we take our standard sort of head and shoulders type of construction, right shoulder, head, sort of left shoulder, this ends up being your neckline, and when the neckline is breached, that generally, when it comes to classical charting, is your signal to sell, although I don't think this is a particularly good setup on average. And then in terms of target, classical chartists will measure from the head to the neckline, whatever distance this is, as their target, and the invalidation tends to be above the right shoulder. Again, not the best trade setup in the world, but as we'll discuss, it doesn't have to be the best trade setup in order for it to generate good signals. Now, again, more examples, your classic triangle type of structure, as I'm sure you've all seen before, when the market is in some form of consolidation and the market breaks out of one of the boundaries, let's say it's the upper boundary in this triangle's case, the buy in this case is triggered on the close above the consolidation structure. The invalidation would be a move back within it, and the target again is usually kind of the widest part of the pattern to give you some idea of where the market might go. Now again, this isn't the best way to trade. I don't think it's even a particularly good way to trade, but it's important to understand the types of structures in the market that will get traders involved. And it's those traders' involvement which is so important for pattern failure. Now the last two examples are very flexible and very malleable. Your basic support resistance type of stuff, so a break of support will usually generate bearish signals. That is to say, you've got a level of, let's say, horizontal support here. When that is broken, market participants will see that as a break of support, and that may generate a sell signal, and vice versa for resistance. A break above resistance may generate a long signal. Again, the core thing to wrap your mind around here is that markets will do similar things. Traders will look at and study those similar things and act similarly around those patterns. And it's this repeated behavior, specifically when it fails, that we want to zero in on and take advantage of the herd to some extent, or at least mass positioning based on the same pattern getting invalidated, because it is their invalidation that gives us good trades. And we're sort of getting into the next slide here, which is pattern failure logic. So the core premise of pattern failure is twofold. The first, going back to the previous slide, is that pattern formation and identification creates positioning. Traders will see some of the stuff we discussed and take position based on those features. Now, crucially, positioning that is wrong or invalidated will typically act as a fuel for reversal. So trader sees a pattern, trader acts on a pattern. If that trader is wrong, they will be forced to close, and it's that shift in the market where they've established a position, they realize they're wrong, and they're forced to close their trades. That sort of failure of the setup to materialize is where pattern failure becomes so helpful. So let's take a basic example of shorting a break of support. Right, classic, let's say, horizontal structure, and you have support, and that support is broken. And as we discussed, the break of support in itself under many systems will generate a short signal. Let's look under the hood and consider what might actually go on. So looking at these bullet points here, the support level breaks, as indicated here. Participants act on that signal and short. And then let's say in this case, because we're talking about pattern failure, the expectation is a break of support is bearish, number go down. So that failing would be number not going down and number going up instead, right? Some sort of failed breakdown, reclaim, deviation, whatever you want to call it, right? The pattern doesn't do what it is, quote unquote, supposed to do, right? As a result, the breakdown doesn't follow through and actually starts going up. And as mentioned, reclaim, failed break, whatever you want to call it. And crucially, that act of the pattern failing is what causes those traders who shorted it in the first place to make a decision. And usually that decision is to close the trade. So participants that acted on that signal, in this case the short, are wrong and are forced to close. This is very crucial. What does it mean to force to close a position in this context? Well, if we think about it from market microstructure point of view, we know that shorts closing, especially if it's done aggressively via market orders, become orders to buy. So if your short position is you go from 0 to -1 and you need to close, i.e. go back to 0, you need to go from -1 to 0, right? So you need to flatten out and therefore buy back your short to go from short to neutral. And that act of closing your short when you're wrong becomes an order to buy, and it's typically a market order to buy. Now, we can look even deeper. As per this bullet point, a lot of the time, the market impact of those positions being invalidated tends to be more significant. And that's because you have a lot of orders hitting the order book around the same price and in the same direction. Again, this should harken back to the market microstructure video, but a good way to think about it analogically is a lot of people trying to exit through a single narrow door. To take our TA example, you have breakdown sellers enter in more or less the same region, i.e. on the breakdown region, and as the market starts to climb up and invalidate them, you have all those same shorts closing more or less around the same area, i.e. the support level whose breakdown they shorted in the first place. So you have a lot of selling interest as the market breaks here, and that selling interest turns into buying interest as the idea becomes wrong. And crucially, that buying interest becomes concentrated more or less around the same area where the sell signal was generated in the first place. So you've got a lot of one-sided kind of demand for liquidity to close those shorts around the same area. And as we know from our microstructure video, if there is a lot of demand for liquidity in one pocket, that is where you get your aggressive and fast moves a lot of the time, right? Hopefully that makes sense. I think if you've watched the market microstructure video before this, it should be very familiar. If not, it's the basic idea of the market moving when traders are using market orders in the same direction at the same price. That's going to have a much larger impact than something a bit more spread out, right? So taking that example and all the other examples that we'll cover and those that come to mind, as per the penultimate bullet point, when patterns fail, they can generate a signal in the opposite direction. And this really speaks to the core of at least my trading system, which is that bullish pattern failure is bearish and bearish pattern failure is bullish. So you're essentially trading the invalidation of participants that bet on the pattern, they got it wrong, and they're now forced to close their position. In general, in trading, you're always going to have a good time trading voluntarily where people are trading involuntarily or necessarily, because they're being sloppy, they're rushing, they're happy to pay a premium or a bad price for liquidity, and you have the luxury of providing that for them, if you will, at a much better price and under your discretion. Hopefully that makes sense. So some examples of pattern failure. I think for Bitcoin dollar, and again, this works for indicators and chart patterns, price patterns, whatever else. I'll use the examples that I like trading, specifically failed breakouts and failed breakdowns. And there's really no better example on higher time frames than Bitcoin's attempted all-time high range high breakout in the 60,000s, right? So this is a very important structural area. It's the prior all-time high and very clear horizontal range high, and you can just see a lot of price action there. The market broke above it, right? This sort of sequence here. Now, typically, as we know, what's the pattern? The pattern is a breakout, and a breakout is bullish. So you're going to have bullish participation and positioning based on the breakout of this horizontal level, and those positions are being established herein. Now, pattern failure is when the market does the opposite of what the pattern should do. What should a breakout do? Go up. Pattern failure is the breakdown not going up, but instead failing to break out, and in this case, the trigger being the close back below the breakout level. And that's a case of what should have been a bullish pattern, the breakout failing, becomes a bearish pattern, and that was very much the start of the downtrend, right? And this is just one example of this pattern working horizontally. We've got another example, the famous, now infamous, I should say, Terra Luna failed breakout around the sort of 44, 45K handle. You can see again a very clear horizontal level of resistance, very clear range high. The market breaks out of it and it looks very impulsive. And again, the pattern at its face value is a bullish breakout. At this instance, the bullish breakout has failed. That's bullish pattern failure. That's bearish, and you can see that was the start of a very strong and very one-sided downtrend. Now, there are some nuances when it comes to pattern failure. And again, the point of this video isn't to spoon feed you setups, it's more to get you thinking about setups in the market in general, as well as your own setups. I'm sure you've noticed in the past, especially if you're someone that uses a trading journal, that you may have you've been invalidated on a long setup, and then, the market takes you out and then completely reverses in the other direction, or vice versa, right? So as long as your signals and your setups are good, when they fail, that's not always just a write-off to variance or too bad, whatever, it sucks. A lot of the time, you can derive useful signal from pattern failure or good setups failing, right? Now, in general, some nuances to make this make more sense, the following. So the first is that the clearer the pattern, the better the setup. Because the idea is that you're going to get a lot of participation and similar participation around the same pattern. So if something's clearer and more easily identifiable, you're going to get more participation around that level, be it from just the setup working on its own, or more helpfully for our use case is that very clear setup failing to play out. Like a lot of those breakouts that we mentioned, they just looked really good. And therefore, if they start looking really bad, everyone that thought they looked really good, they're going to eat a lot of shit. And it's those pattern traders eating shit that acts as the edge or the source for pattern failure setups. And again, the second point is some, re-articulation of the first, that the better the level, the more reliable the pattern. And it comes down to the same thing, that very clear levels will get more participation, and it's when a lot of participation is offside when pattern failure setups work best. There are some trend considerations when thinking about pattern failure. One thing I like to do is to look for pattern failure that aligns with the trend you're trading, if there is one, for confluence. So in an uptrend, I want to see bearish pattern failure for continuation. In a downtrend, I want to see bullish pattern failure for continuation, right? So in the uptrend context, I want to see sellers really step in and get trapped. And I already have the trend on my side, and then I've got extra fuel of bears being trapped. And that's how you get your high probability setup. And it works the other way around for downtrend as well. It kind of acts as an extra boost for a trend. You have trapped participants boosting a trend that's already there. Now, you can also consider using other tools to get a sense of the level of participation at the pattern or at the level or at the structure. Some that come to mind, and maybe separate videos on these later, is you can look at a footprint to see that the amount of market buying, selling, or delta and its relative impact at those breakdown or breakout points. You can see changes in open interest to see how much fresh positioning has been generated by that pattern. And you can also just look at volume for a bit of simple analysis there. But all of these things are pointing to the same thing. We want to see a large amount of participation at the pattern, because all that large participation is going to have to close if they're wrong. And that's when we want to trade. When people establish strong views on the market, those views are wrong, they are trapped, they have to close, they are under pressure, and it's those opportunities where they're rushing for liquidity, where if you're on the other side of that, you're going to have a much better time. Higher time frames, sort of time frame commentary in general, and this again speaks to the first 2 points, if anything, is that higher time frame also gives more visibility, which gives more participation, and gives a bigger reversal upon pattern failure. So kind of a 5-minute time frame failed breakout may not give you a 10-20% move or something massive, but it'll still give you like a rotation relative to the time frame itself. But if you're going to get a very high time frame pattern failure, that's going to give you a larger move, right? So again, it kind of goes back to the time frame video of scaling your expectations of the rotation with the time frame you're dealing with, and it's generally linear. So smaller time frame, smaller trap, smaller move; bigger time frame, bigger trap, bigger move. The next point is something Don mentioned when reading through these slides, that chop is not pattern failure. Again, you'll notice a theme throughout the nuances section that a lack of ambiguity and clear patterns do best. So when it comes to good pattern failure, that those setups are characterized by clear, unambiguous signals that generate positioning. If the market's just choppy, if it's not clear what's going on, if it's not the type of move that's going to sort of generate FOMO, for lack of a better term, then maybe the market's just choppy and it's not going to induce market participants to express views. And I think just going back to first principles, really what this video comes down to is that when the market really tries to do something and it fails at that thing, it's likely going to do the opposite thing. So something that looks very bearish, if it doesn't follow through, that's probably bullish. Or something that looks very bullish and it just kind of gets stuck or doesn't follow through, that's very bearish, right? The best bullish setups are failed bearish setups. The best bearish setups are failed bullish setups. And again, as mentioned at the very beginning, there is a wide range of possibilities under the umbrella term pattern. So get creative. The list is really endless. I think almost any trading system that looks at some sort of replicable, repeated behavior, or really anything, if we even take a broader term, anything that generates positioning, you can apply this pattern failure logic to it. So chart patterns, price patterns, candlestick patterns, indicators that trigger signals, your divergences, whatever else, moving average crossovers, anything that gets participants to bet is prone to pattern failure. And that's really the point of this video. It's to get you to think about what happens when the market makes people trade and those people trading are wrong. And those spots where participants are wrong and recognize it and are forced to close their positions, that's a great place to trade in general. And again, just to go back to the original slide, this comes down to the pattern failure logic, that when patterns fail, they generate a signal in the opposite direction. And it's from a market microstructure point of view, it's because pattern failure typically creates a one-sided demand for liquidity around the same price. And we know that that is a fuel for big market moves. People being urgently wrong and being forced to close is a fantastic catalyst for a reversal. So whatever it is you trade, if there is invalidation and you notice that participants have acted on something and they're wrong, that's when a pattern failure mindset may become helpful. Do I have anything else useful to say on that? I don't want to repeat myself too much. Hopefully the kind of framework that I'm trying to get across is clear at this point, and also just how broad this section is should also come to mind. Indicators, price, charts, whatever. Even if you, and I think this is an important point, even if you don't trade the patterns yourself, pattern failure can be useful. So for example, let's say you think chart patterns are the dumbest thing in the world, and that's not an unreasonable view, and you see this head and shoulders forming, right? You see it forming, and you see it kind of break down, neckline, whatever. Even if you're someone who doesn't typically trade a head and shoulders, if the market starts to make it above the neckline, you can still infer that the participants who do trade this chart pattern or this setup, of whom there are many, you know, from market microstructure point of view, they essentially sold the bottom, and as the neckline gets reclaimed, they're going to have to start market buying to close their short positions. So the good thing about pattern failure is, even if you don't like or trade these setups themselves, you can take advantage of people that do when they are wrong. And this really opens up your kind of trading toolkit or inventory for adding new setups, where even if you don't natively trade the setups yourself, you can still identify when participants that do trade them are wrong and step on their necks when they are invalidated. So that's a really important point. Pattern failure doesn't just apply to the setups you trade. It's really anything that the market trades or the market recognizes that can be a useful source for edge or setups. That's really it. Again, much shorter video than usual, but I think it's more the type of video this is one that gets you thinking about what a pattern is and what pattern failure is, and deriving signals from obvious setups failing. And a lot of the time, I think when you're a beginner trader, it's a very binary way of thinking about it, where you have a setup, and if the setup fails, that's it. You're wrong, you take the loss, and you move on. But what I've discovered over time, and just what I think is a generally useful way to think about the market, is that good setups being invalidated can themselves give rise to future setups. And I think that's something very much worth investigating. But that's all I've got for this video. Apologies, as always, for the long delay between these videos. It just takes a while, to be honest. But we're still building the good old technical roundup. Not even technical roundup, the CRED technical analysis series. And as I've said, hopefully before, I'm grateful for your support over the years, and there is more coming. I'm never getting bored of this stuff. And as I grow and develop and become a better trader, I look forward to sharing all of that stuff with you. If you found this helpful, or if this channel has ever done anything for you, please like the video and subscribe to the channel. All the normal YouTube stuff is helpful. Leave a comment to prove that you're not a worthless TikToker and therefore have the attention span to sit through this. Maybe even leave a comment with pattern failure setups that you enjoy. As always, you can find me, Twitter, CryptoCred, lots of shit posting, some market commentary. If you want more market-oriented stuff, I do a live stream, usually a couple every week, on the Technical Roundup YouTube channel, and there's a free weekly newsletter that I write with Donald, which basically has market levels and analysis that we look at every single week. All of that is free, don't need your money, but I do appreciate your attention and for sticking with me throughout all these years. That's all, take care, happy trading, and I'll see you for the next video. Goodbye.